Okay, welcome back. So we've got the market, which is still under pressure. We're down about 260 points. 18,862 is where we stand at right now. We have Nicolo Bocchin. He's a group global head of fixed income at Azimut Group. Nicolo, thanks for joining us. I hope I got the pronunciations right. Feel free to correct me if I did not. But, we want to talk about... thank you. We want to just talk about the big dominating driver for global markets, which has been, yields pushing higher. These are really large swings on for example, the US 10-year. Hit 5% earlier this Monday, fell to about 4.8, almost back to 5. Tell us, for that market, what's the big driver from here? And do you think we've got a lot more to go from here? Or we are near the peak? What's your sense?
Well, I like always looking at what we had before. We are coming from zero. So before 2022, these values were very, very low, extremely low in a low inflation and low growth environment. Then last year, we went through an inflation shock, not a normal bump in inflation. So it was a proper shock, and now is reabsorbing. In that shock, central banks, which were late probably before in adjusting rates, had to rush and hiking at a very fast pace. That's why we have seen the effect on rates last year being amazing and this year continuing. But last year, the most of the adjustment happened on the short end of the curve, reflecting higher rates by central banks. This year, you are seeing an adjustment on the long end of the curve to reflect higher risk premium, which was completely missing from the scene, and now is finally back. So I have the feeling that we are close to the peaking rates, but I want to see further reabsorption of liquidity from central banks, which is the last piece of the puzzle which is missing. We still have tons of liquidity out there. So if I look at the past, we had adjustment in rates from 0 to 5.5 in US, from 0 to 4.5 in Europe. But from a macro point of view, nothing really happened. From a growth point of view, nothing really happened. And that's because of the huge amount of liquidity still in the market. Where the central banks are withdrawing liquidity step by step. And the path for liquidity withdrawal is still long. So I still see some adjustment on the long end of the curve, simply to reflect a little higher risk premium than the one we have today.
Nicolo, hi. Good afternoon, and thank you for joining us. Last time we saw such high interest rates in the US back in 2007, what followed was a global financial meltdown. Of course, that was not only caused by high rates. There was a subprime crisis. There was a real estate problem in the US. What now? I mean, if rates stay higher for longer, as has been the narrative and the expectation, then what concerns could we be possibly looking at?
Well, the imbalances we had at that point in time were completely different, and we didn't have so much liquidity. That's the big difference. Now we have trillions of liquidity in the market created by central banks to support macroeconomic dynamics in the past few years, or to face the huge COVID crisis. So I don't see anything like 2008, 2009 happening, even because the capitalization of banks globally is uncomparable to what we had at those times. So I don't see anything meaningful happening, actually. We had a major adjustment in rates. I believe that we will have higher for longer rates because the growth dynamics are not bad at all, and because inflation will be a little higher than we were used to be for quite a longer period of time. So there are some major changes ongoing at a global level. We have a deglobalization, we have an extremely strong job market, and we have energy transition. So these elements will sustain inflation and will avoid inflation falling back to 0 or 1% for quite a long time. But in the meanwhile, you have other ongoing forces, which were the forces that brought 30 years of secular stagnation, which is aging population, rising debt, and technology, and that's still persistent. So I still see these couple of years and one more year from now as an adjustment driven by COVID. And I see that all of us going back to the world we had before COVID in 1 year from now, because technology is doing more steps now. Artificial intelligence, ChatGPT are all deflationary elements. So we have forces now acting on inflation, acting on growth. We need to find some stability, but most of the move on rates happened, and I don't see anything dramatic like 2008, 2009 happening, actually.
Okay, fair point. So, yeah, absolutely no comparisons. I was just trying to ask if there's any hidden risk there beyond the 5% headline. But I think the point that you're driving is that there's no real reason to worry about the bond market. There's ample liquidity, and 5% is a great rate perhaps to come and invest in. So the bond market just, continues to hop along?
Focus must be on liquidity only. We went from 0 to 5.5, and nothing happened. If we go to from 5.5 to 6, nothing will happen. The same. The fact is how much liquidity we have out there, how big is the central bank's balance sheet. They are withdrawing liquidity, but very slowly, step by step. They don't want to kill inflation, basically, because you need higher than before inflation in order to make that huge debt pie sustainable in the future.
Okay. All right, Nicolo, we will leave it on that note. Thank you very much for joining in and giving us some perspective. Nicolo there, who's tracking global bond markets very carefully, saying that this is fine. I mean, markets will learn to live with it. No problems. Prashant, I was just hearing him. He says, they went from 0 to 5%. Markets are fine. 5 may go to 6. So 6% is what U.S. Treasuries are yielding. 6% is what the Nifty has yielded in the last 1 year. I wouldn't say more. It's just the high returns that you're getting in the U.S. Treasury markets. I think that may make people think.
Yeah, I hope not too much. The point is, in 2007, in that phase, 2006 to 2008, interest rates moved up about 450 basis points, which is pretty similar. I think with this time, it's up 450, 475 basis points from that level, from the absolutely low levels of 0.25% to where we are now. And of course, we got a big accident back then. Because rates went up, right? The situation this time is very different, but can it be without any consequence? I think that is the only debate. There will be some consequence. Many believe it'll be a recession, it'll be a mild recession, etc. But, markets have been trying to preempt this for some time.
Maybe not financial market consequences like what we saw in 2007, but maybe real economy consequences this time around.
I mean,
we don't know.
we'll find out. But